economic changes that have taken place due to COVID, interest rates have been pushed to historical lows in the United States. And we've published a number of pieces of content that have talked about forcing us to have to look at asset allocation for our clients to try to determine what they do with their bond portfolios going forward. With interest rates as low as they are, it's very likely that over the course of the next 5 to 10 years, or at least probable that over the course of the next 5 to 10 years, that inflation is going to outpace the returns that we earn on our bond portfolio. And why is that bad? Well, it's bad simply from the perspective of our goal for all of our clients, our retired clients, our clients that are trying to grow their portfolios for retirement, is that we're trying to help you grow your spending power with your savings. And for retirees, we're trying to make sure we maintain your spending power. And if we have an asset class that comprises a good chunk of your overall investment portfolio earning less than inflation, it just simply means that we're not keeping up with your spending, right? Or your spending power is getting lost to inflation with that portion of your portfolio. So we've talked a lot about, do we look at adding things like gold and precious metals to portfolios? And for a lot of our clients, you already know that that's something we've already done. Today, we're going to talk a little bit more about what we do from an asset allocation perspective, because what we're going through today is not without historical precedent. So we're going to show you some data of 2 different market time periods and what your portfolio did under different asset class scenarios or different asset mix scenarios during that time period. So I'm focusing on 2 time periods, the period from 1944 to 1981 and the period of 1982 to 2019, so a period that just recently ended, okay? And what you're looking at is the risk along this line measured by standard deviation and return measured along this line of portfolio mixes between stocks and bonds. So what do I mean by portfolio mixes? So let me just circle one item here. So you see a dot on here from 1944 to 1981. And what that portfolio position means that if you started at the very beginning of that period in 1944 with 60% of your portfolio in the S&P 500 index or stocks and 40% of that portfolio in long-term treasury bonds, your returns would have been approximately 8%. And your standard deviation or the variation in your portfolio year to year would have been approximately 9%, okay? Up and down 9% in any typical given year from that 8% return, okay? If instead you had a portfolio that was 100% stock, okay, you would have had returns closer to 11% with a standard deviation of closer to 13%. So again, what does that mean? It means 11% returns over that entire time period, but your portfolio fluctuations would have been significantly wider. Instead of 9%, closer to 13, almost 14%, okay? So why are we looking at these 2 time periods? The most recently ended 40-year time period with the time period that ended at the beginning of the most recent time period, but started 40 years earlier in 1944. The simple answer is, in 1944, the long-term interest rate was 2%, okay? Today, it's about 1.25%, okay? So interest rates from one period to the other were very similar. Now to contrast that, in 1982, the long-term treasury rate was closer to about 15%, okay? So if you bought long-term treasuries, which usually measured by the 30-year treasury rate, in 1982, for the next 30 years, if you just held that bond, okay, you made 15% on your money because that was the interest rate. Compare that to 1944. If you bought that same bond in 1944 for 30 years, you made 2% on your money. So very different. For the last 40 years, it's been very common for an advisor like us, for an advisement group like us, to talk with clients about having an asset allocation that was 50% stocks, 50% bonds, 60% stocks, 40% bonds, 70% stocks, 30% bonds, anywhere in that mix, depending on your risk profile. And the benefit to our clients was that by increasing stocks during that time period, okay, you didn't necessarily increase your risk a lot, right? Because bonds provided a really good return during that time period, okay? So it was very easy to give advice using what they referred to as the modern portfolio theory during the last 40 years because interest rates started so high, okay? So for a client in the last 40 years, the difference between investing in a 60-40 portfolio and a 100% stock portfolio is that they got an extra 1.7% return. But to do that, they literally had to double their standard deviation. So in other words, for an extra less than 2% a year, you had to double the fluctuations in your portfolio returns on a year-to-year basis. So the bottom line is the risk-return equation during the last 40 years has just not been there. It hasn't been worth taking extra risk for the extra return. But that period, we think, is now behind us, right? Now we think we're in a period that's much more like the period that started in 1944, where interest rates at the very beginning were very low. And if you had gone through the period from 1944 to 1981 with a 60-40 portfolio and your returns were 9%, or instead chose 100% stock portfolio, where your returns were 11%, what you got was an extra 40% return by removing 40% of your portfolio from bonds and moving it to stocks with only a 50% increase in your standard deviation. So compare the two time periods. One of them, you get an extra 40% return versus 1.7% return while having the exact same increase in your standard deviation or your risk adjustment, okay? So one of the things we're going to be talking to clients about, in addition to, do you add precious metals? Do you add other types of asset classes that are not correlated to stocks, okay? One of the things we're going to be talking about is, do we move up the fulcrum of stocks versus bonds in a typical client portfolio? Not everybody's going to be able to do that, because adding more stocks does add more risk, okay? It does add more volatility to your portfolio. But for the first time in a long time, we're at a period of time where taking that extra risk, okay, may well be worth it by getting the extra return.